Big changes are occurring in global markets. Japan and the UK both unexpectedly slipped into a technical recession, 2 quarters of negative GDP growth led by weak demand, and this goes to show the singular strength of the US economy. But what does this mean for global markets? Well, today I bring you the stats and the evidence to show you exactly what occurs during periods of weak economic activity. And while the market likes to climb the wall of worry, will this worry turn into deeper economic stress? So with the S&P 500 getting its gap fill and trillions of dollars at stake tomorrow for OPEX, let's talk about stocks and the financial markets together. Hello ladies and gentlemen, welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe. Hit that notification bell. Let's get into it. And if you guys watch until the end, I have a couple of trade ideas for you guys for next week. Great day in the market as a whole. Not so much for technology, but everywhere else was really good. Look at utilities, basic materials, energy, stellar day. Financials too. Great day, great breadth across the board. Technology was looking a little weak. Apple continues to look a bit sick. Software infrastructure quite red. Nvidia weighed on semiconductors, but all in all, semiconductors right here, I would call it a pretty flat day. Software application was mixed as well. Of the mega caps, Tesla was up 7%, and that's just because Elon Musk got the board seats he wanted, the voting rights in Tesla, and that just means his AI ventures are now going to be in Tesla and not separate companies. The market seemed to like that. But all in all, great breadth across the board. 413 gainers, 88 losers. If you're holding RSP, you were up significantly on the day. If you're holding the market cap weighted indices, you are also up on the day. This is what you want to see, and this is what we're starting to see. Last week when I said we're starting to see breadth take up in the market, we want to see follow through. We are getting that follow through. Now let's hop on the charts. This is the weekly chart of the S&P 500, and we can see quite a number of things that's very, very interesting. Firstly, we are positive for the entire week, and all dips after the CPI sell-off and some were bought. Now let's get more granular. Look at the daily chart, and you can see that this right here was the CPI sell-off. We've parred all of those losses in the last 2 days. Bears actually did try and take us lower. You can see by this wick right here. Bulls had more conviction, and we did close the gap. Based on today's trade, we actually opened at the day's lows and then just pretty much rallied all day, closed at the day's highs. There was a bit of selling at the top, but virtually inconsequential, because if we zoom in and actually measure out this right here, that's a new all-time closing high for the S&P 500. And that means we can just go and take this high right here, the 50-50, 50-60 level, and then maybe even get some price discovery to the 50-100. Now we are entering the window of weakness. We do know that gamma supportive dealer positioning is not going to be quite there. So what are areas we can look at if the market does sell off to buy? Now, based on earnings, buy all dips. This is my philosophy right now until we see major changes in the macro. Now we are starting to see that Japan has entered a recession, same with the UK, but I think the UK situation has a lot to do with Brexit, and Japan has unfavorable demographics. The US economy is very strong, and that's why I say all dips to be bought. We know the US economy is strong because of earnings, and I would actually look at right here the 49.20 area to possibly as low as the 48.50 level. I don't think we're actually going to go there, but if we do and we measure it out, we're probably looking from where we are right now. It's about a 3.65% pullback. I do think the SPY is about 5% under its fair value based on earnings. So to have a 3% pullback, you'd be getting the S&P 500 at about a 7 to 8% discount relative to fair value. Now we got the latest II sentiment survey, and bullish sentiment votes actually went down to 42.2%. However, if we actually look at the historical average, still well above the historical average. We saw a tick up in neutral participants as well as quite a big tick up in bearish participants. That being said, the sentiment is still very, very bullish, especially if you look at the historical averages. And again, what this is telling us is any equities you do have, it's just a hold situation. You don't want to really be buying at these levels. You just want to hold, at least according to this. I personally buy every single week, but this is what the data is telling us. Now, this is a trade we took from the 27th of January to February 15th, and it's when the trailing quarter, October 27th to Jan 27th, is greater than 5%. Average return, 2.3%, 21 wins, 5 losses. We've just made it 22 from 5, and had you closed it at the peak, you would have been up 3.18% with a max drawdown of 0.55%, which happened in the first 3 days. So very, very bullish stats right here. Another positive seasonal trading stat, and I think we've had like 8 or 9 of these in a row win. Like, I think the last one that actually lost was maybe an early January one, a turn of the year barometer one, but they've all been favored to the bull side, and sentiment has been pretty bullish. Stock markets have been pretty bullish, so they've just been winners throughout this last 3 to 4 months, which is great. So I'm going to keep giving you guys these trades. Now, looking at a bullish trade that we can take for the rest of the year, this is probably more of an indicator for more bullishness to come. You can actually see the Valentine's Day indicator, and normally when the S&P 500 is greater than 4% or more on Valentine's Day, these are the returns we can expect. Now we are at 4.8%. Average return for the rest of the year, 13.3%. Median returns of 13.7%. Positive 92.9% of the time. Let's call it 93%. And this is a very positive stat, and something that you just love having on your side. The only time it was negative, let's have a look. 2011, okay, what can we say about that? Well, after the GFC, momentum was strong. We had a bad year. It is what it is. Sometimes we get bad years. 1987, excluding October and November, Black Monday, negative 11.7%. This stat would have been positive for the rest of the year. So if you had held equities up until October, you'd be positive. So again, that is an outlier, but according to the stat, still negative nonetheless, and we have to look at it objectively. Now let's look at the majors, just the best performing sectors, mid caps, small caps, and that had to do with what we saw after retail sales. But the RSP up 1.22%, the S&P 500.6, the Nasdaq, the worst performing sector as a whole, but really it was all mid caps, it was all small caps, as well as the broader market as a whole. And the reason why they did perform really, really well actually had to do with retail sales. We got a weak, very soft, very cool retail sales number, negative 0.8%, ex autos, negative 0.6%, core control, negative 0.4%. And the reason why this was a good thing, because we got that hot CPI print, we saw a cool January, cooler than expected, despite seasonal adjustments, and that's going to bode really well for the inflation rhetoric going around right now. The market seemed to like this number, they seem to like a cooler retail print, and it probably means the PPI tomorrow won't be quite as hot, and that's why the market rallied. They really did like the fact that retail sales came in a bit cool because inflation was looking a bit hot for the most part. But looking at the sectors as a whole, the best performing sector, regional banks, GDX, and that was because rates fell on the day, and also like GDX is down like 13% for the year. I'm pretty sure absolutely getting hammered. Energy up there as well. Our energy trades, guys, we've been in these trades since the middle of January, doing really, really well. But all in all, it was really cyclical and sensitive sectors against technology that really outperformed. Look at semis, look at tech, look at software against the SPY, up 0.68%. Then we saw stuff like industrials, healthcare, comm services, discretionary, utilities, financials, all do really, really well. It's, gains 1% upward on the day. Fantastic breadth across the board right there. And it's what you like to see. There's nothing wrong with technology being sold for the smaller sectors in the market. And if we actually have a look at some of these charts, this is the SPY right here. You can actually see that a lot of these charts are looking very healthy. Look at XLI, very healthy chart. Look at XLC, look at XLF. These are very, very healthy charts. Energy finally breaking out from this base we've seen right there. XLV looking very, very healthy. There are some charts that aren't looking that great. I mean, look at utilities, still needs to do a lot of work. Look at real estate, but we do know what's happening with real estate and regional banks. But all in all, a lot of the big sectors, a lot of the important sectors are looking very, very healthy. It's what you want to see. Now, we did also get jobless claims data, came in at 212,000. We were expecting 220. A slight miss on jobless claims, but the American labor market continues to be tight. Unless we see continued misses in jobless claims, I would look at this as a nothing burger. So earnings today, we actually had a pretty big day of earnings. Before the open, we had Crocs, John Deere, Wendy's, stuff I'm not really too interested in. After the close though, we had DraftKings, Roku, Trade Desk, Applied Materials, DoorDash, big expectations on them. But the one I want to look at is Coinbase today. Now looking at Coin earnings, fantastic earnings. They actually beat on EPS right here, beat on sales by a lot. They saw Q1 subscription revenues in this, and they said that FY24 adjusted EBITDA to be positive, and they generated 320 million of transaction revenue. And this is what the stock did in after hours. It was up 3% on the day, 8% after hours, and I do think that it's probably up to 12% now. So a very strong day in coin. Now let's switch gears and talk about risk. This is the BofA Global Fund Manager Survey, and they pretty much asked their fund managers, what do you consider the biggest tail risk in 2024? The top two responses was higher inflation and geopolitics. 27% and 24% put these in their top two. In third place, a systematic credit event, and we do know what's happening with commercial real estate right there, and that's definitely something to be worried about. That being said, guys, these are not risks that's going to happen immediately, and they take a while to evolve. So what you guys need to do is go ahead, follow me, because I'm going to keep you guys updated every single day on how to hedge and protect yourself in case of these events. Nonetheless, in fourth place, we had an economic hard landing, then the US election, and then a China banking crisis. And you can see all the stats right here. In light of that, FMS investors, so fund managers, are still putting money to work. The FMS average cash level as a percentage of assets under management is sitting at 4.2%, the lowest level since 2021. And excluding this outlier, we have to go back to 2013, where fund managers were putting this much cash to work. And in light of all of this, treasuries is paying about 5%. So fund managers are really bullish equities, and they are allocating their money to technology. In fact, they are overweight technology. This is net percentage overweight to technology. This number is sitting just under 40%. And that's because fund managers know tech is where you want to be right now, as well as comm services, semiconductors. That whole sector is probably allocated into year. And this is some of the highest allocation to technology we've seen since 2020. And the reason being is because if we actually have a look at the Magnificent Seven, which is pretty much 6 tech stocks and then a car manufacturer, they are growing their earnings the most. In Q1 2024, they're going to grow earnings at 35%, 20% in Q2, 9% in Q3, and 12% in Q4. And you can see for 2024, double-digit growth for every single quarter except the third quarter of 2024. And this is why fund managers are allocating to technology. However, at the same time, that doesn't mean the Magnificent Seven should be your only trade. Looking at the growth rates for the rest of the world, the MSCI All World Index is going to grow earnings in 2024 at 9.9% on revenues of 4.6%. So there are other opportunities in there, and you can actually have a look at stuff like consumer discretionary growing earnings at 11.9%, healthcare 12%, and a bunch of other sectors like comm services 18.4%, tech itself 19.5%, the most growth there. And that's why people are buying tech, fund managers are buying tech, everybody's bullish tech because they're growing earnings the most. It's not just double-digit growth, it's high teens, low 20s% growth rate for the year. Headlines that were circulating pre the open in the US was Japan's economy unexpectedly slipped into recession, hurt by weak domestic demand. So GDP contracted 0.1% in the fourth quarter. The previous quarter was actually revised down, and that's 2 quarters of negative GDP in a row. And that is a technical recession, mostly on the back of weak domestic demand. And we're going to see what the BOJ does to intervene, what's going to happen with equity markets, especially as the Nikkei is approaching new all-time highs. But let's actually talk about the US. This is the S&P 500 performance during recessions, 1950 to 2022. The modern era, it accounts for all recessions in the modern era. By far, the worst and deepest recession was 2008, negative 56% drawdown, 540 days. Wild when you think about it. 1973, that hyperinflation, I believe it was Nixon or Kennedy. This was 2020 right here. This was 2001 right here. But that being said, this is the majority of recessions you can see in chart form, but this doesn't really tell us much. I actually have the stats here for you guys. Now, this essentially goes through S&P 500 valuation changes in EPS, PE, the S&P 500 drawdown, and then the length of the recession. On average, EPS degrades 21.48%, PEs compress US 25.97%, and the average recession sees the S&P 500 down 31.5% for 321 days. That's the average recession length. But we can actually see that there are extremes to this. Look at the Great Financial Crisis, and looking at this is absolutely crazy. Just for reference, during this period right here, I was 8 years old. Earnings per share for firms in the S&P 500 was down 50%. That's nuts. Multiples contracted 38%, and the SPX was down 56% from peak to trough. 578 days. That's a year and a half of the market going down. And the reason why this is so crazy to me, because that is like 18 months of just stocks moving lower, an actual bear market. And like 2020, right? COVID-19, this wasn't even a bear market. It was 3 weeks of a drawdown and then a sharp recovery after the March OPEX. Guys, my birthday is on the 10th of March, right? This is why I remember this date so clearly. My girlfriend at the time threw a surprise party for me. The surprise party was on the 12th, right? The SVB crisis happened on the 11th in the US. The reason why that caught my attention was because for like 20 minutes at my party, on the Saturday in Australia, it would have been Friday in America, I was on my phone trying to assess the SVB situation going down, trying to like get all the data, stressed at my own birthday party. I looked at my portfolio at the time. It was up about 1% at that point in the year. And then from about March the 10th up until about late October, my entire portfolio had a 22% drawdown in that year. So that is why like this is just so crazy to me, because the drawdown I had in my portfolio personally was in a bear market 6 to 7 months. Realistically, it was in a correction for like 4 of those months, and then like in a bear market for like 2 of those months. So yeah, this would have been a crazy time to be alive. That being said, crazy stats when you think about it. And this is what we can expect if the US does get into a recession. I would expect the current recession to be more on the lighter side than what we've seen here on this heavy side. But nonetheless, recessions are a part of the market, and it's good just to know the stats and be prepared for what is to come. Now, let's talk options, guys. So tomorrow is max pain for the S&P 500 quadruple witching. Now, max pain is at 480. Max pain theory suggests that option sellers and options buyers will feel the most pain. The most options will expire worthless at the 480 strike in the SPY, 4800 strike in the SPX. That's about here. We're well above that price right now, but max pain theory generally suggests that market makers will want to take us to that price to have the most options expire worthless. Will we get there? I don't think so. Can we get there? Absolutely. Now let's talk gamma. Guys, looking at gamma exposure, and yeah, not a lot has changed. We're still sitting at the 5,000 strike as call gamma resistance. We still have quite elevated amounts of negative gamma, and we can see that 50-50, 5100, 5200 continue to be strikes that remain elevated. Now we can see this chart right here on the 15th and the 16th. We have quite a lot of GX expiring, and a lot of this positive gamma is going to be removed off the tape. Once this happens, we have to then watch what happens with fixed strike vol to see where we go next. If fixed strike vol is well supplied, I think the market is probably going to balance between 4950, 5000, maybe make its way up to 5100. But if vol is not well supplied, I really do think we're going to see some problems in the market. So I'm going to keep you guys updated. So hit that subscribe button so you get the updates, because this next period from now up until March 2nd is incredibly important, especially as we go into the March quarterly OPEX, which is a very big OPEX, all things considered. That being said, we are still in positive gamma. We are above the 49.45 gamma flip zone, and that means buy dips, sell rips at the key important zones, 5,000, 50-50, 5100. Those remain the important zones, and we're going to buy dips, sell rips until we get below the 49.45 level, or vol is not well supplied. That is the game plan until March 2nd. Now looking at seasonality, now adjusted for beta, we can actually see that we are tracking pretty much where we should be for the seasonal period. What does this mean now? It probably means we do go lower, at least according to seasonality. We do know that the window of weakness opens, but based on earnings and where we are right now, a correction for this type of price action, especially with what we're seeing in February, would actually be to trend sideways. So if we do go down, if we do go a little bit sideways, do expect that, but I don't expect to see anything major to par pretty much all of the losses we've seen. I think earnings is just way too strong. The economy is just way too strong for us to see that. That being said, do be aware that normally we do see a turn and seasonal weakness this time of the month in February this time of the year on average. Now, looking at the charts, guys, so Russell 2000, I mean, it's looking very, very strong. This is strong. I mean, we put in a low, then a higher low right here. That's bullish. But what Russell needs to do before we start celebrating, what the Russell needs to do is push above this 205 line, close above, and preferably do that tomorrow as a weekly close. If the Russell does that, that's going to be very bullish. And then we can actually start to break out of this massive consolidation area we've been in for the better part of 18 months and look to higher price action. And maybe, just maybe, 52-week highs, new all-time highs. Looking at mid caps, much stronger. This is exactly what you want to see the Russell do tomorrow. Break above this high and close above. Now, mid caps, again, same thing. We want to see follow through. And I think I have a weekly chart of mid caps right here. I do. We could actually see that mid caps is starting to break out. This is a breakout. This is the base right here. It broke above, tested the base, did find a bit of price action below, and now we're going to break these other highs. And we could look at 28.79 right here, and we could look at 29.28 new all-time highs. And I do think we're probably like 3 or 4% away from that in mid caps. Bullish on mid caps. This is very bullish price action, especially when you look at it as a whole and look at it from this perspective. Insanely bullish price action from mid caps. Looking at the equal weight, very much similar to mid caps, although mid caps look a little bit stronger in my personal opinion. The RSP looking strong too. What I want to see the RSP do tomorrow is break through this 161 level, simply because that's a key resistance zone. If it goes and does that, we can then literally go and test the waters at 162, 163, all-time highs 164. Now I have some trade ideas for you guys that you could possibly get in tomorrow for the week. Next week, one is Goldman Sachs Group. Now financials are breaking out, sort of lagging the pack. If you go look at the JP Morgan chart, it really is already breaking above the consolidation period. A very similar looking chart, although a little bit stronger in JP Morgan and Goldman Sachs. We could see here that we tested this area plenty of times right there, right there, right there. We also tested the top of this line, but look at the difference. You can see that we tested this very religiously and held, whereas we've actually had breaks above and tested new highs in Goldman Sachs right here. And I do think that if we do break out above there, that's going to be super bullish, and we do see continuation in the financial sector. And I do think this is a good breakout play in Goldman Sachs. Looking at another breakout play, Home Depot. Now they have earnings coming up. Now we can actually see that consumer discretionary is surprising 13.7% to the upside. We can see that consumer staple is surprising 5.3% to the upside. Home Depot has a history of just beating earnings as a whole. It's why they're one of the best performing stocks in the entire US market. They report earnings on the 20th, I believe early next week. Now if earnings come in line or better, they break above this line right here, we can then look for higher price action and maybe even go to like the 400 area in Home Depot. Now looking at Datadog, another breakout play. We want to wait for this 138 area. Earnings did come out. It was good. Guidance was good. It was in line. A lot was priced in. So I do think the market is just doing a bit of price discovery, waiting for some of the rest of these software server data names to report. That being said, I am actually bullish on the stock, and what I would wait for is a break above the 138 level, break above a retest. If it retests and hold, then I would enter that trade and hold for the 145, potentially 148 level. Now data tomorrow, guys, we got housing start, building permits, and PPI. Now if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video. Cheers.